Here's why insurance is an absolute dumpster fire. Welcome back to this week's episode of the Crushing Debt Podcast. My name is Shawn Yesner, owner and founder of Yesner Law, and welcome back remote today, your financial coach, George Corbello. How you doing, George?
How are you, sir? Welcome back and all that good stuff. But yeah, doing well, buddy. How's it going?
Good. You in the house yet?
No. Apparently, the builders have been ghosted by the building company, which is didn't think I was going to happen. But no, right now it's they're finishing the home, and we're just waiting to kind of get things through. I think right now we were hoping and anticipating in December. Now it seems, hey, Happy New Year. It seems to be more realistic. But again, no rush. I'd rather have a house with four walls and a roof than anything else.
That would be, and I think last week it was a lack of a kitchen sink or something like that.
Yeah. We got at least the kitchen sink, but we still have some counters missing. So
Nice.
we're getting there, piecemeal, little by little, but we'll get there.
Slowly but surely. So, do you have insurance yet?
Oh, I love insurance. It's the most, great topic of the world itself. I love rising prices. I love all of these things itself. So what do you got for us?
So we have a guest this week. This is his fifth appearance on the show, which I didn't realize until I went back and researched it, but it's been way too long since he's been on before. So you heard him in episodes 220 and 221, which were both about business interruption insurance. I had him on 210 talking about COVID because he is also a powerlifting gym owner and ran and oversees powerlifting competitions. So we were talking about COVID in episode 210. And then one of my favorite episodes that I release almost every year, I think I've re-released it, episode 69, talking about hurricane preparedness. So our guest this week is the owner of Advanced Risk Consultants, now the director of risk management at Florida Coastal Insurance Agency, and the Aureat Group. Welcome my friend, my mentor, my referral partner, my repeat guest, Rich Ficca. Welcome, Rich.
Hey, Shawn, George, gentlemen, thank you so much for having me today. Appreciate you.
So you are kind of in the line of fire because you sell property and casualty insurance.
I have never received less Christmas cards in a single calendar year than I have this year, and I have to believe there's a correlation to the prices I'm sending my clients right now.
So why? What's going on?
Yeah, so there's really it's a three-legged tripod of hell that has led us to where the state of Florida is right now in insurance, and I'll kind of quickly go through it with you. So number one, we actually have had a true legitimate uptick in natural disaster, not just in Florida, but across the country and globally. And a lot of people don't realize almost all insurance companies buy a second layer of insurance that we call reinsurance in my world. And that reinsurance is global in nature. So as disasters seem to have taken no vacations the last 5 years, the reinsurance companies are getting killed. Here in the state of Florida, reinsurance represents over 50 cents of every dollar of premium. So in theory, if they get a 100% price increase, they've got to pass that on, just like a contractor would when the cost of wood went up. They've got to pass it on. So the number of disasters has literally increased dramatically, and that has created a real world problem. The second part of that problem is that every one of those disasters also creates a massive opportunity for fraud. Everyone with a 17-year-old roof that should have replaced it, insurance has never been meant to be a maintenance contract. It's not a warranty or maintenance contract. It's meant to cover sudden and accidental events that take your home to a less than safe position. And unfortunately, a lot of people have found that there's a real niche in blaming natural disasters for the condition of their homes. And that has happened not only in the roofs, but the kitchens and the bathrooms, and that amount of fraud. A statistic that will blow your mind: Florida represents about 8% of the claims in the country. It represents 83% of the property litigation in the country. One state, 80+% of the litigation. That has to tell me that there's a challenge there outside of just the events themselves. And then the third leg of that tripod is based on COVID, which you kind of referenced last time I was here to see you guys, is the natural actual cost of everything has gone through the roof. If you go to Home Depot, a 2x4 went from $2 to $10. the cost of a microchip in some places. And again, every appliance, every car, everything now has microchips in it. Went from 30 to 350, right? 350, from $30 to 350 in a lot of cases.
Wow.
And so labor costs have doubled. What contractors were paying a painter 6 years ago is now double today. And so that real world cost, even when there's a legitimate, honest fire, the $20,000 kitchen claim is now a $45,000 kitchen claim. Same exact claim, just based on material supplies and labor cost. So in theory, if the cost of repair, remember, insurance is actually in the repair business. We're in the construction business. We're in the body shop business because we put things back to the way they were before the loss. So when the real world cost goes through the roof, insurance has to mitigate that in some way. So when, again, you take the real world claims, add to it the fraud that it helps to propagate, right, and then add the real world cost of the repairs for either legitimate or fraudulent claims, it has been a tripod that has created what is now becoming considered arguably, it's definitively the worst insurance market in Florida history, and is now being argued as maybe the worst market in U.S. history, to rival what Louisiana, Mississippi dealt with after Katrina, what New York dealt with after Sandy. So, yeah, Happy New Year.
Yeah. And that's what we've been seeing too, is it kind of like, it seems like homeowners and stuff like that, insurance companies are leaving Florida because of what you're seeing and what you've just explained. What options do customers have though when it comes to, you still have to have insurance, you still have to have these things in place. When you're limited, doesn't that kind of, I want to say monopolize, but doesn't that kind of put us in a position where we don't have much choice about the price?
So George, I want to touch on that three ways. It's a really good point. Number one, 85 plus carriers have decided to sit on the sidelines in Florida. 85 carriers have decided they actually would rather not try to make money in this state because in their minds, there's no money to be made, right? And about 15 have gone out of business. And again, this is over about a 36-month period, this last 3 years. But you're talking a baker's dozen companies have literally become financially insolvent, which is why the other 85 are saying, you know what? We're just going to avoid Florida. We really like our operations in Topeka, Kansas right now compared to what we're dealing with down in Florida, right? There's a saying in my industry I've always loved. Never let the aroma, you'll love this as a financial planner, never let the aroma of premium cover the stench of loss, right? Doesn't matter how much money you bring in the door. If you lose 107% of it, you're in a bad spot. And then to your point, because of those 100 plus companies that aren't playing the game, and that's not even just residential insurance, that's commercial insurance, that's all across the board. Because of that, the amount of companies that are left can now pretty much inflict whatever underwriting criteria, whatever rating structure they want, because again, it's good old-fashioned capitalism 101. When there's no players in the market, you can have it in any color you want as long as you want it in black, right? There's only one player. So, but there is hope. And so again, we do see some signs on the horizon. So, but that's kind of what led us to where we are.
So what I did, I got a whole bunch of advertisements for, let us write your life insurance, let us write this insurance, let us write that insurance. And I got a couple of calls from insurance companies that said, can we write this? Can we write that? And I said, well, if you're not going to write my homeowners, no. And so as the consumer, I tried to push back and say, if you want this and this and this, but you want ABC insurance, but you don't want to write D, then I'll do business with a company that does. Now, it may not give me, that's one person in a state of how many million live in Florida, but that was how I tried to combat it. And then the other thing was obviously, working with you to figure out what my best deal was on insurance.
It's a struggle right now. So one of the things that people don't realize is even getting a renewal offer right now is not a given. We're actually telling people, again, it's so bad. One of the things I would share with your listeners that I hope if they take nothing else away from me, even if you're furious and upset at the cost, renew and then find another decision before you just let it go. Because there is a limited number of suppliers for the product right now. And a lot of them, if you have a lapse in coverage, which means you go a day without, they will no longer write you. They don't want lapses in coverage. So I implore and beg not only my own clients, but your listeners, if nothing else, come from a place of agility. And the way to do that is to even renew a god-awful price and then shop. And that way you're not letting go of the one till you have the other. Homeowners particularly, this is different in commercial. So for your commercial listeners, it's a different conversation. But for your homeowners listeners, there's no minimum earned on an admitted product. So if they have a standard traditional homeowners company, they can cancel without much loss of fees or taxes. If they have excess and surplus, that's a different animal. They would want to talk to somebody who can kind of walk through that financial equation with them. But there's the thing. So first, don't just get mad and quote unquote walk away. Make sure you maintain your position of agility. The second is, George, for you, congratulations. One of the few places that is actually still extremely competitive is brand new construction. Because brand new construction, we're not afraid of the fraud aspect, right? And we're also not afraid of having to build it back to code. Both of those things are kind of baked in, or baked out is a better way to say it. And so we're just not as afraid of it, and the pricing still intimates that. So.
Yeah, and I've noticed that as well. It's more of, between new construction and some of obviously the older homes, you're starting to realize, you're right, to get it up to code itself, you got to, do certain things you got to put into the cost of to get it up to code in regards to that. So that also, I imagine the insurance companies are kind of, 50-year-old homes, probably a lot more, sus when it comes to new construction. So that was the one thing truly for us was like, wow, this was not as bad, right? Getting the insurance, doing what we need to do as part of that. But again, the cost was still higher. We're not in a flood zone, so there's certain things you have to kind of worry about, but we still want to include those kind of, kind of insurances. So it's just interesting as a homeowner itself, right? New to this whole aspect. There's a lot of things that we have to kind of look for as part of these kind of things, but we don't know. Like as a homeowner itself, all the details and what to look for from that perspective. For me, it's more of like price. I mean, is price point the only thing we have to worry about? Probably not, but that's what most customers, look for first.
So here's the scary part. Here's the really scary part. When I got in this business 28, 29 years ago now, the difference between the best company and the worst company was a relatively narrow corridor, right? Company A was a little better. Company B was maybe not quite as good, but they all had your best interest at heart. They all had things. The difference between the best and the worst now is the Grand Canyon of existence. There are companies out there that are horrifically bad. There are companies that will purposely price you year one at a rate to get you in the door, and it's literally their business model to give you a 200% price increase the next year.
Wow.
Right? So they're going to get you in the door and then count on either your laziness or your inability to find alternatives to then keep you with them once they goose you to something that the market won't do. There's never been a more important time, and I hate to say this because as the world automates, right? We love automation. We love, quote unquote, cutting out the middleman, right? If I was going to do a TV commercial tomorrow for an insurance agent, I would show a surgeon not in the room. I'd show somebody taking their own appendix out. And I'd say sometimes cutting out the middleman is a bad idea, right? Never has there been a worse time to not have somebody who can answer those questions because the coverage differences, the exclusions on policies, and again, you're not wrong. All my consumers think they're buying is an 8.5 by 11 piece of paper,
right,
which has no value at all until the minute there's Hurricane Ian barreling down. And now all those words matter. And you really want to have those conversations in advance of Hurricane Ian, not when you're told you're not covered.
So what are some other things if I'm a consumer, if I'm listening, if I'm concerned or nervous about my monthly mortgage bill because of the cost of insurance, what do I do?
So there's three things I would say to you. Number one, depending on the size of your mortgage, I've had plenty of clients who've decided to risk retain. And the way they do that is they'll actually pay off their mortgage and then they'll decide to go without wind. Now, again, this is where money is tight. Money is a concern and you can't afford right now. And I'm not advocating that for people who can afford it, or can't afford it. But I'm just saying that's one thing we're seeing all over the place. We have a lot of clients that are taking that stance based on current market. Two, a lot of agents right now, in a typical year, we have to shop 10 to 20% of our clients for what we call sticker shock. So in a normal year in my business over 30 years, 10, 20% are sticker shock. We shop a lot more than that. But those are the people that get a quote, they go, this is ridiculous. Our sticker shock percentage is over 90% right now. So we as an agency are shopping every single client, every single renewal right now. Most agencies are not. And because of that, they're literally saying, take what we've offered you and go away. And they're just sitting in the fetal position because they got even less Christmas cards than I did. So there is still a reason right now to go ahead and take a consumer action and shop the marketplace. You might find what you have. It might realign your concept on what is normal today, which is still a positive activity in itself. You might find what you have is good and make you feel better about what you're paying, or you might find there's some relief. We're saving people thousands of dollars every week right now because they're getting renewals that are 300% increases, and the market does still have some options.
This might be a loaded question, but is it an idea to see what coverages you have and try to make a determination that one coverage may be unnecessary so it can be dropped, or I may need to get a certain coverage and add it in? Is that at all appropriate in terms of the price of the cost of the premium?
So I'll approach that in two ways. One, none of us have a crystal ball. And if I knew that you weren't going to have a claim this year, I'd tell you don't even carry insurance. So it would be easy to say I would never sell to my aunt a policy without replacement cost because I don't want her to get paid depreciated value on all of her stuff, right? What I'm supposed to say to you is, well, you got depreciated value, go to a thrift store and buy depreciated items. I don't want to send my aunt to a thrift store when she needs new shoes. She needs a new TV. So I want her to spend that $500 on replacement cost so she can get new when she needs it. If I knew she wouldn't need it, I would take that right off the policy. What I will say is, in real estate, and by the way, one more point I do want to make because I think your listeners will be excited to hear this. And this is kind of a fun point. This is kind of a math nerd point, so we'll see who follows along. The last 2 quarters are the first 2 quarters in 6 years that the amount of the increases has decreased.
I followed that. I did. I was able to follow. I'm proud of myself. I followed that.
So what does that mean?
You got the lawyer to buy in.
It means the increases are still happening, but the size of the increases decreased for the first time in almost 6 years. That is a real positive because that's a trend line to actually getting back to flat levels, and then flat levels are actually a trend line into getting us back more competitive.
The political jokes write themselves.
Yes, they do.
Rich, the you talk about the policy prices and things like that, the type of policies, high deductibles, low deductibles. There's ways for folks to kind of lower their premiums that way as well. Any concerns in regards to the difference between a low and high deductible policy that our consumers can kind of keep in mind?
Yeah, so the first thing, I teach insurance class, literally pre-licensing classes, and when we teach the brand new, wet behind the ears, soon to be insurance agents, we say who's going to carry high deductibles and who's going to carry low deductibles. And low deductibles, they think of your doctor, right? They think of your wealthy person. And they say, oh, that guy's going to carry a $250 deductible on his auto. I'll use that as just for the sake of this story. And who's going to carry the $1,000 deductible? Oh, the poor guy who can't afford insurance. What I would challenge you is it should be the exact opposite. So there's 4 ways to handle risk and without wasting your time. One of them is risk transfer, that's buying insurance. One of them is risk retention, which means roll the dice yourself. What I try to teach my consumers is you should never roll dice you can't afford the outcome of. So when somebody tells me I can't afford a 2% wind deductible, I say, why? And they go, I can't afford the extra $700 that it cost me on my insurance. I'm going to go to a 5% or, God forbid, a 10% deductible on my wind insurance. And again, for the sake of this conversation, if we have a $400,000 home, that guy just took his wind deductible from $8,000 to $40,000. And he'll advocate going to that 10% wind deductible because he can't afford the $700 it saves him. Right. And I say, if you can't afford $700, how do you afford the extra $32,000 when the storm hits? You live on a, if you're in
That's a
Pinellas
really
County, you
good,
live on a
either a
peninsula
really
on
good
peninsula.
emergency fund or yeah, exactly. So
Well, I mean,
that's the key.
the issue there is if you were going to do something like that, what you would then do is say, okay, I'm going to estimate that I'm going to have to spend this deductible in 5 years. And so I'm going to break that 32 grand over 60 months. But the reality is I wouldn't have a job. George wouldn't have a job if the majority of people did that.
We're advocating higher deductibles for our clients who can afford it right now.
Right.
For clients who are
sense.
financially sound, we are absolutely advocating more risk retention and to arbitrage against the marketplace. Right? We've made risk transfer too expensive in some measures. Risk retain, it's a better deal. The only problem is the caveat to that is you should only do that if you can afford it. One of my favorite sayings in the world is I always every couple months I get a cute, adorable 70-year-old couple that calls me and says, "We don't want to carry homeowners insurance anymore. We paid off our mortgage." And I say, "Amazing, congratulations. Can you afford to replace your $350,000 house?" They go,
Right.
"Shucks, no." And I go, "Well, then you still need insurance because you can't afford the risk." And it's kind of an eye opener for them.
So, but is there, so let's say in an example like that, they pay off their $350,000 house. Do they need as much insurance as they would need if they had a mortgage? Or the way I think of it is car insurance. So I lease my car. Nissan says because you lease, you have to have X levels of car insurance, liability insurance, whatever. If I pay off my car, can I drop that insurance to save a little, can I be less covered? Although I'm probably answering my own question. Can I be less covered to save on the premium?
So if you have nobody to answer to, you can obviously risk retain more and pay less. But here's the thing. What you can't do in the insurance industry is decide to insure $1 million home for $300,000. And the reason is that when $1 million home, right? So if you had GC on here, he would tell you that a kitchen represents about 30 to 40% of the value of a home, right? That's what that room is supposed to cost in the value of a home. Right. So if I have a $400,000 house, I got a $100,000 kitchen sitting there. We will not let you insure your $1 million home to 300 grand because that's still a $400,000 or $300,000 kitchen. So when the kitchen fire happens, we're going to have to spend more money even on a minor fire based on the build, construction, design, materials of it. So the industry won't let you back off. So you can take more risk in the form of deductibles, but you still are going to have to insure the value in most situations.
Okay. One of the last questions I wanted to ask you about, maybe we're going down a different kind of rabbit hole, but one of the things you helped me with earlier this year was I was with Citizens, and then we moved away from Citizens and we moved to a different company. So maybe take a little bit of time and talk about, for people that may or may not understand, what is Citizens, and then when would it be beneficial to look at, okay, I'm with Citizens, maybe it's time to leave them and move to a different insurance company or insurance underwriter.
So first, guys, this is a whole nother episode. Let me warn you, but I'll try to be succinct. So okay. First, Citizens is the port of last resort. It is established by the state, but contrary to popular belief, it is not backed by the state. The last 4 governors have all made comments that they will not bankrupt the state of Florida for a policyholder who could have gone elsewhere and decided to pay less money to put themselves into Citizens. Let me say that one more time because most people don't realize this. Citizens is not backed by the guarantee fund in the state of Florida. So if an admitted carrier in Florida goes out of business, Florida writes you a check. They blessed the company coming in, they write the check. If Citizens goes out of business, they have no responsibility to do so. They're also not backed by the full faith and credit of Florida. Now, both of you understand when people say it's not backed by the full faith and credit, it means we don't necessarily want to pay. Citizens right now will openly tell you that they have too many policies. They will openly tell you that they are trying to move every policy out they can. There is a concern, and again, this is a whole other episode. I will tell your clients, if for anything reasonable, and that varies person to person, they can get out of Citizens, they should. If you can get out of Citizens, you should. Even if the price is more, as long as it's quote unquote reasonable, run with your life, because we're going to be in real trouble with the amount of policies and citizens right now.
Okay. Well, and from my understanding, and I think you sort of referenced this at the very, very beginning, it's not just that as a Floridian, I'm concerned about the storm that hits Florida, but one of the other things that impacts my rate is the tornado that hits Kansas, right?
Correct.
Okay.
But the problem is Citizens has all its eggs in a Florida basket.
Right.
So that's even more problematic for Citizens than most of the other companies that do business here and balance that out in other areas.
Well, I guess wait for episode number 2 for part 2 of this episode, so we can talk about that a little bit more. Because now I'm interested in understanding what this is and how that impacts folks as well.
Well,
Rich, let me. Oh, go ahead, buddy.
I was going to say I know a good agent you can talk to, George, if you have questions about your policy.
There you go. I got a good referral partner. I love it. Let me ask this. I mean, we've talked about a lot of things that we should be doing, we should be keeping in mind. Obviously, a lot of doom and gloom. There's a lot of things to worry about as a consumer. What does 2024 look like, for you in the business as well as, for the customers you're going to be serving?
So prices. So again, I shared with you guys, the increases are decreasing, which is a trend line in the positive direction. I've actually spoke to 3 of my carriers on fourth quarter meetings that have actually said they're looking to go back into a growth mindset for quarter 1 of 2024. And frankly, part of that's because pricing is so high right now. They're starting to think they can make some money. So that's a positive. That should create competition. I think if our legislature does some things to stop the fraud, I think if the policy specimen itself starts to require maintenance of the asset at a little bit more responsible level, I think that will create, and I think we're headed there. I think we're going to start to see, or it's already actually coming, and again, I don't want to get in the weeds, but we're already starting to see the first clauses in insurance contracts that basically say things like, if your roof is new, you get all the money. If your roof is old, you get a little bit of money. And right. So we're starting to see proration contracts like on car batteries. And I think there's a real value there. If your water heater is 9 years old, you should have replaced it. You shouldn't really probably get any money if your water heater pops. And and so we're going to start to see that. If we see those changes, I think we're going to see the market. We actually have history for this, George. There was the mold fraud of the 90s. There was the sinkhole fraud of the early 2000s. And when they legislated the changes, we actually saw 30, 40, 50% price increases in the marketplace. I think we'll see that again.
Increases or decreases?
Decreases. I apologize. In the marketplace. I think if we get a little bit of competition again, we get a little bit of legislation, I think we're going to see pricing come down significantly. I don't know that we're ever going to get back to pre-2019, 2020 levels again, just because the 2x4 hasn't got back to those levels. Right?
Exactly. That makes sense.
But I think we have some hope, is my point.
So as we get kind of towards the end, anything we missed? Anything you want to add?
No, I just think there's never been a more important time for a consumer to look at what they have and have an intellectual conversation with somebody who can answer conversations about it. It matters now more than ever before, and they should do that.
And so just anybody listening to the show, can you write outside of Florida? Can you write policies outside of Florida?
Yeah, I think we're currently, again, depending on my clients, I think I currently write in 35, 36 states. So we don't write in every state. We write in a ton. We prefer to write in Florida just because it's our bailiwick. But for the right client, we go out and extend that as well.
Cool.
Nice.
Well, thank you. We appreciate you being a guest again. Episode number 5 for you. So thank you, sir, for being on the show.
I feel like if this was Saturday Night Live, I get a gold jacket now or something.
Yeah, I was about to say we got to get him a bottle of bourbon or something. And you're like,
I think that's just for guest hosting, not for guesting.
Got it.
So.
Good point.
So speaking of insurance, we do want to mention our longtime friend, our longtime sponsor, Sam Cohn with Attorneys First Insurance. He wrote me a little note, so I'm actually just going to read it. I normally plug him in my own words, but I'm going to plug him in his own words. National Insurance Agency with a specialty working with lawyers and title companies, focusing on errors and omissions, malpractice, or professional liability. They all mean the same thing. He is a concierge service. I can tell you that from experience. He works quickly. I can also tell you that from experience. If he can't help, he'll let you know quickly. He wanted me to give out his phone number and challenge anyone who wants to call him that he will answer on the first ring. So his number is 727-799-4321. So again, number 727-799-4321. And I challenge you to call him and see if he picks up on the first ring. Other than that, I also want to mention our Patreon page. So patreon.com/crushingdebt, because George and I both have insurance premiums that we need to pay. As well as we're going to work on editing. We already are improving some of the equipment for the show, but we're going to get back to working on editing. Rich, real quick. So I know I've got your email and your phone saved, so I can always contact you. But if someone does want to contact you, where should they go?
Yeah, so the name of the agency, so forgive me, it's long but easy, is Florida Coastal Insurance Agency. So my email is richard@floridacoastalinsuranceagency.com. And our phone number is 727-569-6000. And again, we write anywhere in Florida and through a lot of other parts of the country.
Cool. Well, thank you again. I appreciate you being a guest on the show.
Gentlemen, thanks for having me. Happy holidays.
Yeah, absolutely. Happy holidays. I think when this episode will be out right before Christmas. So,
Right before Christmas, yep.
George, I hope you have a Merry Christmas. I will have a Happy Monday.
Yep.
Because Hanukkah just ended. So you can have a Merry Christmas.
Yeah, you're already done your festivity, 8 crazy nights.
Yeah, we're done with the 8 crazy nights.
Nice indeed. No, yeah, we're gonna celebrate, have some good food, some hot cocoa, and
eggnog. Do you do? I really never got into eggnog. Do you guys do eggnog?
Not my cup of tea.
So you can mix bourbon with it, and it will really change your opinion of eggnog.
I may try some eggnog.
Bourbon is good.
Yeah, I may try some eggnog now. So. That'll do it for this week's episode. Thanks again to Rich Ficca. We hope that you can take some of what he has talked about in this week's episode so that you have more money at the end of the month rather than month at the end of the money. Everybody have a Merry Christmas. We will talk to you in next week's episode and have a Happy New Year after that. We'll talk to you later.